Imagine you are an average American in 2026. You have $500, $5,000, or even $50,000 to invest. You know that keeping your money in cash means inflation gradually erodes its purchasing power. But you also know that investing can build long-term wealth, so you decide to invest. Immediately, you face certain unavoidable problems. You might not have a huge amount of free capital. You might lack the adequate knowledge required to build wealth. You might be busy and simply not have enough time to dedicate to the markets. And you might not have a high capacity for taking risk. So what is the solution? A solution to all these bottlenecks is not possible until we understand the root cause of each of these problems. Once we know what we are searching, locating the treasure is easy. The very first problem that we all face is lack of capital. Suppose you want to own shares in the largest and most successful companies in America. Ideally, you would like to invest in companies across technology, healthcare, finance, industrials, consumer goods, utilities, and energy, not just one or two. But building a well-diversified portfolio can require substantial capital if you are purchasing many individual securities, especially if you are trying to mirror a broad market index. The first problem is simple. Most investors don't have enough money to efficiently build a highly diversified portfolio on their own. A mutual fund solves this by pooling money from thousands or even millions of investors into one large investment pool. Instead of investing your own $1,000, you are effectively participating in a portfolio that may collectively hold billions of dollars in assets. Pooling doesn't increase your ownership percentage, but it gives you access to diversification that would otherwise be difficult or excessive to build individually. The second problem or the bottleneck is lack of knowledge. Successful investing isn't just about buying stocks. Someone must continually decide which companies to buy, which companies to avoid, how much of each company to own, when to reduce exposure, and how to respond to mergers, bankruptcies, or changes in corporate fundamentals. As an average American, we have careers, families, and other responsibilities. We don't spend our days reading financial statements, listening to early calls, or analyzing balance sheets. A mutual fund delegates those decisions to professional portfolio managers operating within a stated investment objective. You are paying not just for stock selection, but for a structured investment process. The third problem that we all have is lack of time. Even if we deeply understand finance, investing well requires ongoing work. Markets change every day. Companies release quarterly earnings. Interest rates move. Economic conditions shift. Industries rise and decline. Maintaining a diversified portfolio requires monitoring and periodic rebalancing. Many investors simply don't have the time to manage this consistently. A mutual fund centralizes that operational responsibility. The fourth major bottleneck is lack of risk management. One of the biggest mistakes new investors make is concentrating too much money in too few investments. Owning only one or two companies exposes your wealth to company-specific risk. If one business suffers a major setback, your portfolio may be heavily affected. Mutual funds reduce this idiosyncratic or company-specific risk by spreading investments across many securities according to the fund's strategy. This doesn't eliminate market risk. If the overall market falls, many diversified funds can still decline, but it helps reduce the impact of problems at any single company. So what is a mutual fund? A mutual fund is an investment vehicle that pools money from many investors into a single, professionally managed portfolio of securities. Instead of each investor buying and managing dozens or hundreds of individual investments independently, the fund invests on behalf of all shareholders according to a clearly defined objective. Each investor owns shares of the fund, not direct ownership of every underlying company. The value of those shares rises or falls within the value of the fund's underlying investments. A mutual fund is not primarily about earning high returns. That's one of the biggest misconceptions. Its original purpose is to make investing accessible, diversified, professionally managed, and operationally efficient. High returns may or may not result depending on the fund's strategy and market conditions. The real innovation was democratizing access to diversified investing. Instead of being reserved for wealthy families and institutions with large amounts of capital and dedicated analysts, mutual funds enabled ordinary Americans to participate in professionally managed portfolios. So far, we have established that mutual funds pool money from millions of investors. But once your money enters the fund, what actually happens to it? Who holds it? Who decides where it's invested? Can the fund manager simply do whatever they want? And how is the value of your investment calculated every day? That's exactly what we will uncover in the next lesson. How mutual funds actually work. Subscribe so you don't get left behind. Learn investing one bit at a time and build independent wealth rather than struggling and depending on others to pull you up.